In this video, we are going to talk a little bit about corporate finance, an introduction to corporate finance. So what is corporate finance? Corporate finance, also known as managerial finance, addresses the following three questions, or the following three key questions. There is a lot more questions to answer, but these are the three key ones. In what long-lived assets should the firm invest in? Let's talk manufacturing, for example. Should they the size of the plant in which they're going to produce their product? Should they expand down the road? Should they contract? Should they change equipment? How can the firm raise cash for required capital expenditures? Okay, so in the previous question, we were deciding what to buy, what size of a building to buy, for example. The question number two is, where do we get the money to buy that building or that plant? Three, how should short-term operating cash flows be managed? Well, while the first two questions talk about long-lived, long-term, as anybody knows, you still have to survive the day-to-day operations and the short term in order to reach those long-term goals. So you have to have a plan for your cash management so you don't go bankrupt before you reach and achieve those long-term goals. So known as the capital budgeting decision, think of a balance sheet. For example, on the left-hand side of the balance sheet, you have current assets, fixed assets, tangible, intangible, etc. On the right-hand side, you may have the liabilities, long-term debt, and then you have the shareholders' equity. As you know, liabilities plus equity equals assets. So here we revisiting the question, and what long-term assets should the firm invest? So we're looking at this side of the balance sheet, the assets. What are we going to buy that is going to eventually be listed here in the fixed assets? Then the next question is, we're going to buy things that we're going to list here, but over here is where we get the money: liabilities, debt, equity. You can issue stock to raise capital, so that's your shareholders' equity. You can borrow money, sell bonds, for example, commercial loans, and that is your long-term debt, for example. So this is how you get the capital. But then there's more to it. Okay, you can do everything in equity, or you can do everything in debt. Most of the time, you do a combination. You borrow some money and you get some from the equity side. But then the question is, well, how much from each? And that's what the capital structure decision talks about. If I need $1 million, what percentage do I borrow through debt? And what percentage do I get from selling equity, shares to stockholders? And as we mentioned before, you still have to survive the short term in order to get to the long-term goals. Here is an important piece of that equation, which is the current assets versus the current liabilities, representing the short-term needs of the company, the current liabilities. So also known as net working capital. The difference between current assets and current liabilities is known as your net working capital. So this minus this equals this. So the question is, how do you manage that? How much of this should you have? Well, clearly you should have at least the same amount, but that's dangerous. That's risky. So you always want to have a little more, and that's why the square is a little larger than this rectangle you see here. How much more? It really depends on the industry, the company, and all that. Or your expectations of future sales, economic expectations. A lot of things vary, but you have to plan ahead to make sure you have enough of this to cover this so you can stay open, stay in business. So the financial manager Now we're getting into the whole management side of managerial finance. The financial manager's primary goal is to increase the value of the firm. Let's stop right there for a second. Increase the value of the firm. That's what the financial manager does. Not only increase the value, but to maximize that value, increases by as much as they can. Now, how they do it? Selecting value creating projects. So as they make decisions, where do we invest our money? What long-term assets we buy? Where do we shift the operations of the company? All those could be different projects, and you may have several opportunities, but you have to select the ones that are going to create the most value. Making smart financing decisions. Well, very general, but this applies to everybody's personal life and in business and everything. You have to make smart financing decisions. Very unspecific, but all it means is that on average, you are better than you were before by your financial decisions, that you're not just constantly losing money on most of your transactions. Here's a hypothetical organizational chart. It's a very general, basic one. Each company is going to have their own way they organize their officers and board members and everything. But this will be your typical approach. You got the board of directors. Under the board of directors, you got the chairman of the board and chief executive officer. Now, they don't have to be the same person, these two positions, but it typically is. But it doesn't have to be. The chairman of the board and the CEO does not have to be the same person. It's just typical. And right under the CEO, you have the CFO, which is the chief financial officer. Now, not mentioned here, you also typically have a chief operating officer. And where do they fall? Definitely under the CEO. But do they fall to the next to the CFO or under the CFO? That really depends on the company, could vary, but there is such a thing. But here, because this course is about financial management, managerial finance, we are just saying where the CFO falls under, because we're only looking at the finance side of the organizational chart. Of course, there's HR, there's marketing, there's all kinds of other departments. Under the CFO, Chief Financial Officer, it's typically broken down to the treasury or treasurer and controller. Now, a lot of financing and accounting activity going on here, but here's the split. And the treasury is where the treasurer works, and that's where they do the cash management we spoke about, credit management. That's that short-term stuff. But by credit management also, it could be some of the long-term debt if you do it commercial loans, for example. Capital expenditures, financial planning. So a lot of the stuff that we spoke about in the earlier slides and questions falls here. In the controller side, you got tax management, financial accounting manager. We'll talk about that in a second. Cost accounting manager, information systems manager. So these are more operational and less about the financial management. As we spoke about, the questions that are being asked fall more here. Now, financial accounting manager, think of the financial statements. Of course, those have to be prepared. And then they're used here for the questions and the plans and the decisions that need to be made. So an imperfect way to see this is more operational. And then here's where falls what we're going to be talking about most of this course. The importance of cash flows. So we always hear a lot about the income statement, profit and loss, P&L, and the balance sheet. They're important. But cash flow, it's what keeps the company alive. Companies do not go bankrupt because of negative net income. Net losses can eventually lead to bankruptcy, but that's not what makes a company go bankrupt. It's when they run out of cash. So that's why cash management is so important to keep the doors open and the operation going. So as we mentioned earlier, you raise capital through bonds, commercial loans, selling equity. So those are your financial markets. So you get that cash. That cash comes over here to the company. So that's A. Then we have B. So that cash is used to invest in assets, that building, that plant, that inventory, etc. And you go through operations. Now we're talking about, so that first stage, get money here and buy that. That's pretty much how your balance sheet is built. Then you run to operations. So you sell some stuff minus the cost. How much did you keep? So that's more like your income statement. Now, your income statement doesn't necessarily reflect cash, but you can extract the cash number from there. So cash comes in, you buy assets, you use those assets to make money and sell. And then after you paid all your expenses and costs, you're going to have some cash flow from the firm. So the next thing you have to do at that point is pay taxes. Now, the income statement, I brought it up here because I need to make a distinction that this cash flow from the firm already reflects what was paid on interest on what we call debt service, the interest that you had to pay from your liabilities, from your debt. And then after you pay that, whatever is left as your net income, you have to pay tax to the government. After that, you have your net income that moves on to retained earnings. Then from there, you have to decide, are you going to pay dividends before you do your final retained earnings number? Now, I mentioned interest got paid here from your debt, but then you see debt payments here after you pay taxes. Think of this more as the part that gets paid to principal, not the interest. Or if you also have what we call free cash flow, which we'll discuss later, think of it as paying down your debt if you want to, but not to be confused with the interest payment that was done over here, the stage before the taxes were paid, and then the cash that goes that way. And then you're putting that money back into the financial markets, in other words, return dividends, which is the return on the equity, debt service, etc. And this is pretty much the regular, not the regular, but the broad view of what the typical cash flow looks like. So the goal of the financial management, the question comes up, what is the correct goal? Should we maximize profit? Should we minimize cost? Maximize market share. Could be argued that you minimize cost, you're maximizing profit. If you maximize market share, depends how you do it. If your costs stay the same or you go down, then your profit will go up. So all these kind of like work around each other. But at the end of the day, as we mentioned earlier, we have to maximize shareholder wealth. We do that through the value of the firm. By maximizing the value of the firm, you're maximizing shareholder wealth. Now, what happens is that how do you do that? You do it through these mechanisms and many other ones, of course. But these mechanisms, sometimes you got to aim for maximizing profits. Sometimes you got to aim for minimizing costs. Sometimes you got to aim for market share. It really depends what's going on. There's no straight answer. How do you maximize shareholder wealth? You just make decisions according to what's going on, to the market conditions. Now let's talk about the agency problem. We're shifting gears here a little bit. So technically speaking, the shareholders own the company. And through voting and other mechanisms, the management gets hired, as in the CEO, CFO, the board of directors, etc. So now what you have is the CEO and CFO and all these managers are the ones running the company. The shareholders own the company, but they don't run it. Now, does the CEO have a lot of shares? Is he a shareholder? He or she is a shareholder as well? Yes, of course. But the point is that no, not all stockholders are active managers. So now the point is, how do we get these active managers to run the company in a way that the stockholders get the most value. And the thing is that it doesn't always work that way. That CEO, that CFO, their goal is to maximize their personal benefit, their personal value. So they just want to see how they're going to get paid, how they can maximize their pay, short-term, long-term, whatever it is, they're going to maximize their benefit. Sometimes maximizing that benefit may actually hurt the value of the company. They may extract wealth in a way or transfer wealth from the shareholder to them personally. And the details of how that happens, we can talk about that some more later down the road on this course. So the idea is that becomes what we call an agency problem. When the management is not in line with the interests of the shareholders. And that's why here we say agency relationship. The principal hires an agent. Principal being the stockholders, they hire the CEO to represent his, her interest. Here we go. Stockholders are the principals, managers are the agents to run the company. Agency problem is when there's a conflict of interest between principal and agent. And typically is the agent going in one direction that is not in line with what the stockholders will belong to, which is simple, maximize their wealth. So management goals may be different from shareholder goals. Expensive prerequisites, survival, independence, increased growth in size are not necessarily equivalent to increase shareholder wealth. So CEO will make the decision that they want to capture a lot of market share, but that was not necessarily the best strategy at the time, according to the market conditions, or decide to borrow more money that they should have, increasing the risk of the company in order to have more cash at hand to do other things. However, that may actually decrease the value of those actions. And then you have a problem. So now, how do the stockholders manage the managers? The number one way is incentives on their contracts. You set the goals of what you would like to see, and then the incentives, the bonuses, the options, all kinds of extra money will be dependent if they meet those targets. Now, there is no perfect set of incentives. You do the best you can, and you try to minimize the agency problem, but there will always be some. There is no perfect way to do that. And even if you do find a perfect way, these CEOs, the CFOs, these managers are smart people. They're just going to find another way to work around it to increase their personal benefit. So incentives are very common use. Corporate control, the threat of a takeover may result in better management. In a nutshell, what happens is if you have a company with a lot of potential, but the CEO is not doing a good job and the CFO, they're not doing a good job of maximizing wealth or the value of the company, that's going to bring the stock down in price. Other investors from other companies are going to see that opportunity as to like there is value in that company. They're not properly extracting that value to show in the stock. So the stock is cheap. So the plan is you buy the stock cheap, fire the management, and it's a corporate takeover. Another company takes over. So that threat is an outside threat is another way how CEOs and managers can be controlled to say, well, you have to keep the company healthy and valuable. A little about regulation out there in the financial sector. We had the Securities Act of 1933. It regulated issuance of securities, and a year after that, another act is the one that declared to create the Security Exchange Commission, which is the SEC. And notice those years, 1933 and 1934. It is not a coincidence that was a few years after the big crash in 1929 that caused the depression to come after that. Well, one of the big causes for the depression. There was a lot of other elements going in place. So regulation was needed, and these were the first steps. A lot of things have happened throughout the decades and a lot of regulations, but the next big one, to put it that way, was the Sarbanes-Oxley. Have you heard of Enron? If you're not, it's an interesting story. There was this huge fraud committed by a company, an energy company called Enron, and new regulation had to be in place in order to prevent the things like that happening again. It was a big financial fraud, accounting, between accounting and finance people colluding to make the numbers look in one way that were not right, and there was this huge collapse, prompting this one. Okay, ladies and gentlemen, that's it for the lecture on this chapter. We will see you on the next video.